There is a number that sits inside your retirement plan like a landmine. It has a name that sounds like a minor bureaucratic inconvenience. Most people who get hit by it had never heard of it until the bill arrived. And the thing that makes it genuinely infuriating is not the money itself. It is the fact that it was entirely avoidable. All of it. Every single dollar. And the window to avoid it was years earlier, when you still had time to act. I found out about this the way most people find out about things that are going to cost them money. Not from a financial professional, not from a government brochure. I found out about it from my neighbor Phil, who was standing in my driveway on a Sunday afternoon with the expression of a man who had just discovered a leak in his roof. Phil retired from the school district after 31 years. His wife Denise worked in administration at Ohio State. Good people. Responsible people, the kind of couple who paid off their house early and actually read the paperwork when it arrived in the mail. They did not consider themselves people who got surprised by large bills. And then they got their Medicare notice. Phil showed me the number. I'm going to use round figures because I do not remember the exact amount, and because the exact amount is not the point. The point is that it was roughly $10,000 more per year than he and Denise had planned for. Per year, not a one-time fee, every year, for as long as their income stayed above a certain threshold. That conversation happened about 3 years into my retirement. I was 56. I had been doing what most people do in the years after they stop working, which is spending money without any particular system and trusting that the math would eventually make sense. The morning after Phil's driveway visit, I made a phone call I probably should have made much earlier. What Phil got hit by is called IRMA, Income-Related Monthly Adjustment Amount. It is Medicare's way of saying, if your income was above a certain level 2 years ago, you pay more for your Medicare premiums now. Part B, which covers your doctor visits and outpatient care. Part D, which covers your prescriptions. The surcharge kicks in at different amounts depending on how much your income exceeded the threshold, and it keeps climbing as income goes up. The part that catches people off guard is the 2-year look-back. Medicare does not look at what you earned this year. It looks at what you reported on your taxes 2 years ago, which means that if you had a high-income year 2 years before you turned 65, and retired people often do because of Roth conversions, because of selling a property, because of taking a large distribution from a traditional retirement account, the surcharge follows you into Medicare like a delayed invoice from a transaction you barely remember. For context on what this actually costs, the surcharges in recent years have ranged from a few $100s per person per year on the low end to several thousand per person on the high end. If you and your spouse are both on Medicare and both triggered a high enough income threshold 2 years back, you could easily be looking at what amounts to $10,000 or more in additional premiums annually that you did not budget for. That is not a rounding error in a retirement plan. That is a real line item that changes the math. Here is what I did not know, and what Phil did not know, and what I suspect a meaningful percentage of people reading their Medicare welcome packet for the first time do not know. This surcharge is not permanent. It is not a penalty in the traditional sense. It responds to your income level. Manage your income differently in the years before Medicare starts, and you may never pay a dollar of it. I want to be clear about something before I go any further because this matters to me, and I have said it before on this channel. I am not a financial professional. I am a retired operations manager from Columbus who spent 6 years figuring out what nobody told him before he stopped working. I do not give financial advice. What I tell you is what I experienced, what I asked questions about, what I learned the hard way, and what I heard from people I know personally. If any of this moves you to have a different kind of conversation with someone who actually knows your specific numbers, then that is the right thing to do. What I can tell you is what that phone call the morning after Phil's driveway moment led me to understand about my own situation. I had left my job at 53 with a separation package that included a 401k with roughly 30 years of contributions in it. I also had a pension. I was not withdrawing from the 401k yet. I did not need to. and I had been told in a vague, general way that I should defer withdrawals as long as possible to let the money grow. That advice, while not wrong, was incomplete in a way that would have cost me money if I had just followed it blindly. The problem with leaving all that money sitting in a traditional pre-tax account is that eventually you have to take it out. The IRS requires it. They are called required minimum distributions, and they start at a certain age and they do not stop. Those distributions count as income, and income, as Phil's Medicare bill had demonstrated, has consequences that go beyond just paying income tax on it. High income 2 years before you hit Medicare age means IRMA. High income in retirement means higher taxes on your Social Security. High income later means larger mandatory distributions, which means higher taxes on those, which can trigger even more in surcharges. The concept I kept hearing, once I started asking the right questions, was that the years between when you stop working and when you turn 65, or whenever Medicare begins for you, are a window, an opportunity window. Your income in those years is often lower than it was when you were working, and lower than it will be when you start taking Social Security and required distributions. That window is when some people choose to do what is called a Roth conversion, taking money out of a traditional pre-tax account, paying the tax on it now, and moving it into a Roth account where it grows tax-free and does not count toward future income calculations. I am not telling you to do that. I am telling you that I had a series of conversations about my own situation in which this concept came up, and that I made certain decisions about my own accounts in my own specific circumstances that I believe will affect my Medicare costs when I get there. The point is not the Roth conversion itself. The point is that I did not know the window existed, and I would not have known the window was closing until it was already closed, if Phil had not been standing in my driveway with that look on his face. Phil is a good-humored man, fundamentally. He was a shop teacher before he moved into administration. He still has calluses on his hands from projects he does in his basement. He is not the kind of person who spends a lot of time feeling sorry for himself. But there was something in his voice that Sunday afternoon that I have thought about more than once since. He said, "I knew about taxes. I knew about Social Security. I read everything I could find about Medicare. I just did not know about this one." That sentence has stayed with me. Not because it is unusual, because it is so common. The things that cost people money in retirement are rarely the things they spent years worrying about. They are the things that nobody thought to mention. The quiet charges, the adjustments, the lookbacks that arrive 2 years after a decision you thought was neutral. I asked Phil what triggered it. What was the income that crossed the threshold 2 years before his Medicare enrollment? It was not anything complicated. In the year before he retired, the school district offered a voluntary buyout. Phil took it. He was 62, he was ready. The package included a lump sum payment on top of his regular salary for the year. He paid income tax on it. He moved on. He did not think about it again until the Medicare paperwork arrived, and the premium column did not match anything he had budgeted for. The buyout was not a mistake. Accepting the package when it was offered was the right call. Phil does not regret it. What he regrets is not knowing in that moment that the income from it would follow him like a shadow 2 years into his retirement and show up in a column labeled Medicare Part B Surcharge. Phil and Denise are managing. The surcharge, in their case, lasted 2 years before their income came down enough to exit the highest bracket. But those were 2 years of additional premium costs that did not go toward the road trips they had been planning, did not go into the renovations Denise wanted to make on the house they have owned for 27 years. It went to Medicare premiums, at a level that had nothing to do with the health care they received. I have a friend named Marcus who retired from state government 2 years after Phil. He had watched what happened to Phil from close range. We all live within a few blocks of each other in the same Columbus neighborhood. And Marcus had a specific conversation with his accountant in the 18 months before his Medicare eligibility. I do not know the details of what Marcus did or did not do with his accounts. That is his business, and he did not volunteer it. What Marcus told me when I ran into him at the hardware store about a year after he turned 65 is that his Medicare premium was what he had planned for. He said it the way someone says something that they are quietly, specifically grateful for. Not triumphant, just, it worked out the way I thought it would. After watching Phil, that felt like no small thing. What bothers me about this, and I have spent some time examining why it bothers me as much as it does, is not the amount itself. The amount is significant, but it is not catastrophic for most people who get hit by it. What bothers me is the timing. By the time most people find out about Irma, they are already in it. The decision that triggered it was already made. The tax return was already filed. The 2-year look-back clock is already running. And the nature of the surcharge means that even if you lower your income this year, you are still paying for what happened 2 years ago. You are always, in a sense, paying for a version of yourself you no longer are. That asymmetry, where the decision comes before the consequence by 2 full years, requires you to think further ahead than most of us are trained to think. When you are working, the future is mostly theoretical. When you stop working, the future is where you actually live. And the decisions that shape that future are made in the present, years before the bill arrives. I turned 59 this year. I have been retired for 6 years. I have watched people I know navigate this transition, and I have noticed something consistent. The ones who feel most caught off guard in retirement are not the ones who made bad financial decisions. They are the ones who made good decisions in isolation, individually sound choices that nobody had assembled into a complete picture for them. Phil made good decisions. He saved. He paid off the house. He contributed to his retirement accounts the way responsible people are told to do. Nobody told him that the income from those accounts, combined with the timing of his Medicare enrollment, would interact in a specific way that would cost him $10,000 a year in premiums he had not budgeted for. That is not a failure of character. That is a failure of information. And I think about this in connection to something I have been trying to articulate about this stage of life, this particular years into retirement stage, where the choices are not urgent in the moment, but are quietly shaping what the next decade looks like. The freedom of retirement is real. I have said this before and I mean it. I walk 5 miles most mornings. I spent 3 months last spring building a bookshelf in the garage that I had been designing in my head for 2 years. Carol and I drove to Montana last August and took our time about it. But the freedom that retirement gives you is also freedom without a map. Nobody hands you a schedule. Nobody tells you what to optimize for. In operations, I spent 30 years knowing exactly what I was supposed to be doing and why it mattered. In retirement, you are building the map while you walk it. And that is mostly a good thing. Mostly a beautiful thing, honestly. But it also means the invisible structures, the rules that govern your finances, your health care, your taxes, keep running in the background whether you are paying attention to them or not. They do not care that you are on a road trip in Montana. They do not wait until you get home. Irma does not announce itself. Nobody calls you to say, by the way, the income you report this year will determine your Medicare premiums in 2 years. You have to already know to ask the question, and you have to ask it before the window closes. The thing I keep coming back to is the 2-year gap. It means that the version of you who is making the decision is not the same version who pays the consequence. You make an income decision at 62. Say you take a large distribution from your traditional IRA because a renovation came up, or a grandchild needed help, or you just did not think about it. And the version of you at 65, signing up for Medicare, finds out that the 62-year-old version made life more expensive. You cannot go back and fix it. You can only move forward. What you can do, if you are in that window right now, if you are somewhere between when you stopped working and when Medicare begins, is look at your income in a way that accounts for the future consequence. That looks different for everyone. Some people find that their income in the pre-Medicare years is already low enough that it is not a concern. Some people discover, as I did, that a series of reasonable individual decisions has added up to a picture that warrants a different kind of attention. I am not telling you what to do with your money. I am telling you that I had a conversation I should have had earlier, and that it changed how I think about the years between 53 and 65. And I am telling you that Phil, standing in my driveway on a Sunday afternoon, gave me something worth more than $10,000. He gave me the question before the bill arrived. That is the only thing I know how to do with information like this. Pass it along before someone else finds out the hard way. There is a version of this story that ends with me telling you everything worked out perfectly, and I have completely figured out the finances of retirement, and here are the 3 steps to make sure you never pay an unnecessary dollar. I do not have that version. I have the version where I am still navigating it, where I still call people with more knowledge than me when the questions get specific, where I am occasionally surprised by something I did not know to look for. What I have learned 6 years in is that retirement is less like arriving somewhere and more like keeping a very large house in order. There are rooms you maintain consistently and rooms you forget about until something goes wrong. The financial rooms are the ones that tend to go wrong quietly, without symptoms, in ways that only become visible on a document that arrives 2 years after the moment that mattered. Irma is one of those rooms. If you are approaching 65 and you have not had a specific conversation about how your income in the current year affects your Medicare costs 2 years from now, that conversation is worth having. Not because I told you to, because Phil stood in my driveway with that look on his face, and I would rather you avoid it. That is where I will leave it today. There is one more thing I want to say, and I am going to say it plainly. If you are in the window right now, meaning you have stopped working or are close to stopping, and Medicare is somewhere between 1 and 7 years away for you, the question worth asking is not whether you can afford retirement. You have probably already answered that question to your own satisfaction, or you would not be here. The question worth asking is whether the income picture you have built for these years accounts for what it will look like on a tax return 2 years before you turn 65. Not just what it cost you now, what it reports then. That is a different question. It requires looking 2 years out from a specific birthday at decisions being made right now. Most of us are not trained to think that way. We think about this year and maybe next year. The 2-year Medicare look-back requires you to think from 65 backward and connect the dots to decisions you are making today. I am not saying this to alarm you. I am saying it because I know what Phil's face looked like in my driveway, and I know what it cost him, and I know that the cost was not because he failed to plan. It was because nobody put the right question in front of him at the right time. The right time is before the decision, not after. If this is something you have run into, if you got hit by Irma and no one warned you, or if you are someone who managed to avoid it and you have a specific moment that made the difference, I genuinely want to hear it. Drop it in the comments. I read all of them. More than that, these conversations down below have become something I did not expect when I started this channel. Real people, real situations, none of the polished advice energy, just people talking honestly about what this stage of life actually looks like from the inside. That is the thing I wanted when I was 52 and had more questions than anyone around me seemed willing to answer honestly. It did not exist, so I made it. If what you heard today felt true to something you have been living or thinking about, I would be glad if you subscribed. Not for a number on a screen. Because the people who end up in this community tend to be the kind of people who ask the real questions. And those are the conversations I find myself thinking about long after I step away from the camera. Hit the bell so you see it when the next one goes up. Take care of yourself. And maybe check on your neighbor.